If you do go live on that channel, you can paste something up there to let them know that we're live on this channel. Okay? Perfect. All right. I'm excited for Business Credit Mastermind number 3. We're going to be good. This is going to be good. When we last left our intrepid folks who are stuck in the mire of debt, we had gone over budget and the difference between lines and loans, and now today we're going to actually talk about how to implement business credit, or not business, well, we do want to implement business credit strategies, but today we're doing credit banking strategies. All right. So giving some time for some folks to be able to get on. And, you know, I want to, of course, give a shout out to all the people that are on the webinar, of course, to Chase and Grant, and Latha, as well as Lacey. I'm grateful that all of you are here. All right, we got some good stuff going on. Okay, so let's go ahead and let me share my screen. Get that up here. Let's see here. All right. We're talking about credit banking, of course, and the search for the lost American dream. And I'm excited because today's topic and discussion is really going to center around the actual implementation of this strategy, because we've had to lay a lot of groundwork. I mean, to be able to do credit banking, you have to start with a budget. I mean, we have to know how much income's coming in, and we have to know what our expenses are to even have any idea if there's any cash flow. And then to apply that cash flow to the right debts, right? Because we use we calculate our debt efficiency, and we want to pay off all of the low efficiency debts and make sure that we take that and we keep the high efficiency debts and pay those off last. So that's a lot of stuff that we've covered. And we've talked about the different ways that interest is amortized, because a lot of us have credit cards and we have loans and we have various lines of credit, but understanding how expensive each of those different banking products are and the way in which it's paid back. Is it a one-directional loan? Is it a revolving line? That goes a long way into how expensive the money is. So today, what I want to share with you is how to implement the business credit strategies. Now, of course, my name is Joseph Smith, and my business partner, Ray Fleming, who's working all of the bells and whistles and buttons and switches. We're here to help you, and today's training is a weekly ongoing mastermind. Throughout the year of 2020, we are going to be coming to you every Tuesday night. And for those of you who don't know how to participate in this wonderful mastermind, because it's $6.99 a session for those who join, unless, of course, you're one of our existing clients. And then, you know, this is just something that you get as an added bonus. But I want to show you where to go. So if you see here, you go to our website. You go to wiseguysandties.com/credit-banking. When you do, you see you got to put in your name, your email address, and your phone number. That information just goes to me, and I'm not going to give that out to anybody. I don't have a relationship with somebody who's buying information. I don't sell it to anybody. And then for legal purposes, you have to check mark off all 4 of these boxes and agree to these statements, which basically does not hold me liable for any mistakes that maybe you make in implementing the strategy. I highly recommend that you take the information that we go over and we talk about and we work together, but then go check and see if these strategies work for you, especially in your jurisdiction. And some people's situations are different. So we have to always take that into account. a lot of the information that we go over on these webinars are general in nature and general in scope. But for you specifically in your circumstances, in your situation, can glean a lot of stuff from what, and a lot of good strategy for your finances from this mastermind. But you ultimately have to do your own due diligence and make sure that this is going to be a good fit for you. After you do that, there's this lovely form. Now, all of this is optional. If you just want to participate in the mastermind, but you're not interested in sharing your information, that's totally fine. But we have a lot of folks every week that put in their financial information. So your net monthly income, your total monthly expenses, so then we want to talk about your available credit limit, right? So how much you have available. And then we want to talk about how much are you currently utilizing of that credit? So what are your balances? And then we need to understand what the interest rate of the line of credit is. And some people might have interest rates all over the place. Some are at 0, some are at 9, maybe others are at 18, 25. You can down here where it says current situation, you can itemize that all out if you want to, or you can just talk about your largest line of credit that you have that you want to use to do credit banking. Then we have you talk about your loan that you want to pay off. Now, you might have multiple loans, and I only give you a room here to put in one loan. But if you want to go over other loans, you can just put that down here in current situation. Basically, in the time that we have on this this call, the goal is for the first 20, maybe even as much as 30 minutes of the call, we're going to spend on training. And then the last half of the call, we're really going to go into looking at somebody's numbers and talk about how would we implement credit banking strategies utilizing somebody's numbers. And we can mastermind it at that point. I look for some of your input and I give you some of mine, and then we come up with some options. After that, then we're totally open to questions, and you can submit questions at any time throughout the entire webinar. But as I'm training, I might not get to it till we reach a good breaking place, and then I'll answer questions, of course. But I definitely want you to understand the format is you come in, you get a little bit of training, and every week we focus on something different to give you a little extra edge or nuance of credit banking that you might not have heard of before. And then we dive deeper and we answer questions, and then we do a real life example and we answer more questions. And if the conversation is robust, we reach the end of the hour, but we have a lot of questions still coming in, we'll extend it up to another half hour. If people are really getting some good value out of this, we'll just keep it going. All right. But on average, we typically end about an hour. We've had pretty much a good discussion and people got other things to do. All right. So with that said, if you want to participate, all you simply have to do is go to wiseguysandties.com/credit-banking, and then you come to this page, and then you're able to, as I said, fill it out and then get started. Super excited. There's my boys. If you can see my desktop, I don't know if that's actually sharing, but I love them. All right. So we're talking about credit banking and the search for the lost American dream. What is the search for the lost American dream? Really, we always define that as financial freedom, and that's really the purpose of this mastermind. Let's work together. This is a group of people that already have achieved financial freedom, who are working towards achieving financial freedom, and people who are in search of financial freedom and they haven't even started. So this is where we get together and we go on this journey together, and this is awesome. So we're your grateful hosts, Joseph Smith, Ray Fleming, the Wise Guys and Ties, and that's our contact information. We do give people a free 30-minute consultation. Now, 30 minutes is not really a lot of time to go into everything in depth, and I do encourage people to come and put their information into go to that website page I just showed you, and give us your information. As we said, Wise Guys and Ties, right? We want you to go to wiseguysandties.com and /credit-banking and put in your information. And that way, it's like after the 30-minute free consultation, it doesn't have to end. Every week, it just kind of keeps going. We do help people in terms of we do further consultations, and there are costs involved with that. But since this is free to you, you might as well take as much advantage of it as possible. There just really are more of you than there are of me. So this is the best way that I have found to meet with all of you and be able to help you. All right, so moving right along, that's Ray Fleming, who will actually not be talking today. I don't know why his information came out. Let's skip forward. He is a good-looking guy, but we're talking about credit banking today. All right. All right. So why credit banking? Why are we talking about this? Let's talk about a bit of the mindset behind credit banking. Why this strategy? Why not making extra payments or double payments? We've all heard of different strategies on how to pay debt down faster. It all centers around this mindset. See, employees use their cash as their currency, and that creates a cash scarcity mentality. And what do I mean by that? A cash scarcity mentality is when you put all your eggs into one basket, you're now very protective, because as you take eggs out of the basket, you notice that the amount of eggs starts decreasing, right? As soon as you put all your money into, say, the bank, right, and then you start taking it and paying off all the monthly expenses, then at the end it's gone. You live in a sense of scarcity because you keep seeing the money that comes in goes right back out. Credit banking is a way for us to utilize leverage, other people's money, and to change that mentality. So rich folks, they use leverage as their currency, and they use cash to accelerate and grow their wealth by creating an abundance mentality. All right. Because when you take all of your cash and you put it into your own bank account, and then you take your cash and you spend it on all of your expenses, that's scarcity, because it's always constantly coming in and then it's gone. But when you use other people's money, right? We talk about that, those three letters, OPM, other people's money. We call that leverage. You're leveraging their money. So your money comes in and you put it into your line of credit. And the beautiful thing that happens is your money doesn't go anywhere, right? It's converted, right? It's like when you use those math equations and you convert from degrees Celsius into degrees Fahrenheit. It doesn't go anywhere. It just takes a new form. Your cash then becomes credit. So what can you buy with a credit card? I ask that question a lot of folks. What can you buy? And people can name a whole bunch of things. And then so we say, well, what can't you buy with a credit card these days? And that list is pretty hard to think of. Eventually I have somebody say, well, I can't pay a mortgage, can't pay my auto loan. Okay, there are workarounds, there are ways around that, but for the most part, we can buy everything with credit. So if we have money that comes in and we convert it into credit, we haven't really lost anything. We've just changed the currency that we're using. Following me? I went from US dollars to now I have euros. I've gone from euros to now I have yen, right? Now I go, whatever it is, we're just changing the currency. So what rich folks do is they use other people's money as their currency. They use the credit, right, to pay off their debts, to purchase things, right? Their cash that they have, they use to service that debt. So if you have credit cards and you purchase stuff with credit cards and you make payments for services and you buy things, you can take something that might cost $4,000, $5,000, but you have a small $150, $250 payment. Okay, so if you have all your cash coming in and then you convert it into credit, right, and you make that big purchase, next month when your cash comes in, you're just paying that down. You're just paying those little payments, and the rest of your cash is available in the form of credit. Now, when we talk about credit banking, when it's described in words, it for most people goes like, I'm sorry, I don't get it. The point that I'm trying to make is that when you take your money and you spend it on your bills and your debt, then it's gone. And so now you have scarcity. Where did it go? We have to go make some more. And then you run into this situation where you run out of month before you run out of money. You're always robbing Peter to pay Paul. It's just scarcity. There's never enough. But when you start learning how to leverage this line of credit, that loan, this credit card here, and you start combining them all together, you're able to keep more available working cash and credit on hand. And so when things happen, because life happens, right? When an emergency happens, we have the ability to handle it without going crazy, right? Right now, when we live in the scarcity mentality, if one thing goes wrong, just one thing, like all of a sudden the tire blows and we got to get new tires, we don't know how we're going to cover that. All of a sudden, there's a health emergency that happens, and now we have to start figuring out how to pay that. When we're living paycheck to paycheck, there's no room for emergencies. So, but we do have credit cards, and so for the emergencies, we throw that onto the credit card, but then we can't afford to make the credit card payments. And as you know, it begins to cycle and spiral down, metastasize, and grow cancerous, and it devours not only our money, but it devours years of our life. It devours our well-being. That peace of mind that we have, the love of life, begins to drain from us. So let's find the solution. Why credit banking? I like to share people because it rapidly reduces your debt and it increases the monthly cash flow. You have more cash available to you on hand because you use credit banking. You have the ability to start, when you start having access to more money, you start having more independence. You're not dependent and have to borrow money and you're constantly tied up with all these creditors. You begin to, eventually, the end goal is you become more of a bank yourself. You become a money lender. That way, I mean, because why not? I mean, banks are awesome. They have such a great business model and it's perfectly legal to take other people's money and lend it back to them at a great interest rate. I mean, can't beat them, so might as well join them, right? But there's so much stress centered around finances because people don't understand them. And we do our best, but I mean, who went to school and learned about interest? Who went to school and learned about amortization? Who learned about how to budget appropriately? These skills aren't taught. What you're taught is algebra 2. I mean, what you're taught is Greek mythology. I mean, these different things that seemingly have no useful purpose for our lives. In the context that they're taught, there are a lot of applications for different things that were taught in school. But if we were to prioritize what's really important, what is the information that we wished we would have been taught so that we knew now? That's not what's taught to us. It feels like a lot of our time was wasted in school learning things that we never use. I mean, I don't know about you, but I don't graph many parabolas or parabolas, depending on how you pronounce the word. I don't really spend a lot of time calculating the volume of a cylinder. I don't. I just see that there's a beverage in there and I drink it and it's gone. But the point is, once that stress goes down and there's more money in the bank, I guarantee you, your spouse is going to find you way more attractive. Your loved ones are going to think you look good. It's all because of a completely different mindset. Credit banking leads to a whole bunch of abundance in your life. So we're talking about what is credit banking? Well, this is my definition. I mean, how do we define it? Credit banking, as I define it, uses your lines of credit to free up cash flow to transfer highly expensive and amortized loan interest. That's what we went over last week. We talked about how it's amortized, right? We did all those math formulas to figure it out, right? Well, it takes all that highly expensive amortized loan interest and it converts it into simpler and less expensive forms of interest. This has the effect of radically decreasing the number of loan payments that you have to make, and that reduces the total interest that you have to pay. And so all of that combined aggressively pays down your principal, the principal loan balance, the total amount that we're actually trying to pay down. It gets paid down in 1/3 the time that it would normally take, and at hundreds of thousands of dollars less than what it would cost you. Do you see, credit banking is very difficult to define, and it goes by so many names. People call it velocity banking, people call it cash flow banking, people call it infinity banking, mortgage sweep strategies, debt reduction strategies. And there's little nuances and slight differences in all of them, but the general overriding principle is the same. When you learn how to convert really expensive interest into less expensive interest, then you're able to reap the benefits of paying things down faster and not having to pay as much in interest over time. So how do we do that? Well, we're going to take a look at the budget. Now, again, keep in mind that this is mastermind number 3. We've already been through, we're in the 3rd week of going over this. And every week we're going to go over something different. So a lot of what you see on your screen is stuff that we've already covered in previous masterminds. And that's okay, folks. We'll cycle back, we'll come back around, and we'll re-explain budgeting, and we'll re-explain lines of credit and loans and amortization. We'll go over all of those things. But I'm not going to go back and redefine everything. I'm going to pick up sort of where we left off and just keep the ball moving, right? So a few assumptions that we have to know. So we're looking at the budget here, $5,000 on a 2-income American family. And you see the pie chart of where it goes to. You got $1,200 goes towards the mortgage, $600 to the auto payment for 2 cars. You got $600 in credit card payments, $1,200 in your cost of living expenses, your food, entertainment, utilities. And then you got $1,400 going into short and long-term savings. Such as like when you contribute to your company's 401k, things like that, or if you have an IRA, or maybe sometimes you put a little bit of money aside into an actual savings account. That's the budget on the screen. And so what we're going to do is we're going to show you how you can take this average budget, these numbers that we just averaged from the US Bureau of Labor and Statistics, and we're going to show you how you use these, how these numbers and how we work with an average budget and begin to implement credit banking. But you have to know that we are going to make a few assumptions here. We're going to assume that your income is not going to change. It's not going to go up. It's not going to go down. And we're also going to assume that your expenses here aren't going to change. Like you're not going to all of a sudden have an increased credit card bill, or your we're not all of a sudden we're moving into summer and then all of a sudden all your bills have gone up. We're in this example, we're taking advantage of the fact that things are going to stay static just for the sake of us doing math, because we're rounding all the numbers here. Your numbers probably don't match what you see on the screen exactly, but the principle in this is going to remain the same. So here's what we're going to do. Let's take a look. We've got our little plane, and when you start doing credit banking, things move in a hurry, right? So we're going to take that money, and instead of putting it into the bank, we're going to immediately apply all of our income to our line of credit. Now, what's that? Once you do that, what happens? Well, you don't have to make that minimum credit card payment anymore. That $600, if you're putting $5,000 of your monthly income directly into your line of credit, you don't have to pay that anymore. Isn't that great? Now, we got a question coming in. All right. Just got the text hour live on YouTube. All right. Perfect. Wonderful. Okay. So when you put $5,000 onto the line of credit, you've more than paid the minimum monthly payment. So you don't have to budget for that anymore. So where does it go? Where does that $600 that was here that we did have to pay for, Where does that go? Well, my technology has decided to freeze up on me. That's okay. We will get it to work again. Not a problem. Gotta love technology when it works. Okay, so here we are. So we have we had that $600 payment. We now don't have to budget for it anymore. It's gone. Where does it go? Right? It goes into our cash flow. Do you see that? We didn't have to get an extra job. We didn't have to work any extra overtime. But by not having to budget for that minimum credit card payment, that's now calculated into our cash flow. A lot of people find that hard to conceptualize because they think, no, I've got to make that payment. That payment's still there. No, not if you overpay. That minimum payment is just that. It's your minimum payment that's calculated. If you put more of that in there, is in fact what we're telling you is to put all of your income into your line of credit. You don't have to budget for the minimum monthly payment anymore. Also, we talked about not putting the money into your 401k or your IRA because you're just or even into your savings account because you're just giving people your money to make money off of you and you don't really make anything. And so you're going to learn through credit banking how to gain your financial freedom, but also I encourage you to learn about how to invest your money. Learn how to invest in real estate. Learn how to, if that's not your thing and you want to invest in something else, learn it. Don't give your money to somebody else to be your broker. Become your own broker. Learn how, I mean, for me, I think you should invest in real estate personally because everybody already is investing in real estate. The money you pay in your mortgage or your rent, right? You're already paying money. You're either building your dream or somebody else's. Might as well be your own, in my opinion. But still, stop putting money away and giving it to other people to make money off of you. And so we encourage people to take that money and start repurposing it, refocusing it, because you could benefit greatly from that money today and eliminating your debt. And then once we've eliminated your debt and you've achieved some financial freedom, we then can grow your wealth, right? We can grow your wealth by investing your cash flow into things like real estate or other assets. So if we're not saving the 1,400, we're not putting 1,400 away into every month into our 401ks, right? We now have redefined our whole budget. So before, where it appeared like we didn't have any cash flow and we were living paycheck to paycheck, we just stopped putting money into our retirement and we stopped putting money into our savings account and we stopped allocating money to set aside to make the credit card payments. Now, so far, all of this should sound pretty crazy. What, you want me to take all of my money and put it into my credit card? How are we going to eat? How are we going to pay the bills? Right? I mean, it's a principle that I said earlier. When you convert your cash into credit, it all comes back to you. Well, not all of it, but 90% or more of it comes back to you. So that's why we want to utilize this as a strategy so that we can increase our cash flow. As you see here, we're already increasing our cash flow by simply implementing basic credit banking strategies. I mean, we're not working any extra. We didn't get a second job, right? And if you look, you can see our monthly expenses, like our utilities, our cost of living, Netflix, going out to eat, whatever our food bill, none of that changed. So we're not asking you to cut back and scrimp and save and live in scarcity either. We're just changing how we pay things. Okay, so now we freed up $2,000 of cash flow. Let's look at how this actually works. So we have our lines of credit. As you see, we have a $15,000 limit. That could be on one card or one line of credit. That could be across 3 cards or more, but we have multiple lines of credit. And so now we're carrying a $12,000 balance. Making that minimum monthly payment would take a very long time to pay that off. But look at what happens when we start using when we start using our credit banking. So things are going to move very quickly, as fast as the airplane, right? So the airplane comes in and we're putting all the money. And so what happens to our $12,000 balance when all of a sudden we just dropped $5,000 on there, right? When we do that, we can't forget that we've got to put $3,000 of expenses, right? So we put $5,000 on, and then we've got to put immediately our $3,000 of monthly expenses right back on our card. But do you see our balance has dropped to $10,000? So we started with a $12,000 balance, and in 1 month, we're now down to a $10,000 balance. The cash flow that we free up is the speed at which is how quickly we pay down our debt. So if you're just making your minimum payments, it's like walking, right? That's the speed, and you've got to do a marathon. You've got to go 26 miles and you're walking, right? That's what it's like. And then when you maybe make an extra payment, now you got in a car, right? Or maybe you're making double payments, you're in a sports car, right? But when you do credit banking, you're getting in an airplane, right? You are going hundreds of miles an hour. You are getting this done fast. All right. So now, because we're paying our debt down at a speed of $2,000 a month. So this $12,000 balance, if we're paying it down $2,000 a month, how long is it going to take if we keep this going every month for us to pay this off? It gets paid off in 6 months, right? Do the math. And we are still paying interest. That 21% interest that you see there, a lot of people are scared of credit cards because of the interest. But don't forget that it's an APR, an annual percentage rate. You have to take 21% and you have to divide that by 12. That comes out to about 1.75% a month. 1.75% that is of the balance that's carried over. So 1.75% of the 12,000 in the first month, 1.75% of the 10,000. So you're paying 1.75% of a balance that's continuously shrinking each month. By the time you make it to the end of the 6 months, it has cost you $730 of interest, right? But if we stop using the credit card, now imagine this: stop using the credit card. Now, who's going to stop using the credit card? I mean, go with me for a moment on this, because we're not talking reality, but we're talking hypothetical here. If we were to stop using the credit cards, meaning we're not going to pay any new purchases on these cards, but we do continue to make that minimum monthly payment, that $600 a month. If we make $600 a month, how long does it take to pay off? It would take over 28 years to pay off the $12,000 at the $600 a month rate. That would cost you $16,504.64 in interest. 28 years of making these payments, right? This minimum monthly payment, $16,504.64, right? Using a credit banking strategy, we paid it off in 6 months, and it only cost us $730 of interest. Do you see? So if you want to make the minimum monthly payment, then I mean, again, that also assumes that you're going to stop using the card and that you're going to make every payment without missing one, right? Because are we going to, in the next 28 years, probably need to use our credit card again? Obviously. So when in reality, we never pay these down. We can never escape the trap, because we always look at things by making the minimum monthly payments. That can't be done. Sometimes we get into a windfall, like it's tax season's coming up, right? And we're going to all be getting our tax returns. And what does everybody want to do? I got my tax return, and so they're going to dump it into their credit cards or pay off a whole bunch of bills. And then they feel great. They're like, yes, we paid all that down. But what they don't realize is you took all of your money and you paid off debts. You now have no money. You are now cash poor again. See, that's a problem. With a credit banking strategy, we want you to keep more of your cash on hand. We want you to have access to more cash flow because we want to leverage other lines of credit. We want to use our debt. We want to keep our cash as a way to make the payments, right? Not just the minimum payments. Obviously, the minimum payments at a minimum, right? A minimum payment at a minimum. But when you get a windfall like this, and you just pay off a debt with your cash, it's gone. But if you're able to use a line of credit and make a huge payment with a line of credit on your debt, and then take your windfall and pay off line of credit, two things happen. You still are paying your debt down, but you use somebody else's money to do it. And when you paid that off with your large windfall, that money returned back to you in the form of available line of credit. So you didn't really lose access to that money. But if you just take all your money, oh, hey, we got this check, we pay off all our debt, it's gone. And then what happens? Well, life happens, of course, and then something happens, and then we got to use the line of credit again. We go into debt, and this time it's worse than last time, and we can't pay for it. We can't afford it because we used all of our money to pay off our debts. And all of a sudden you find yourself next year in the same place you were the year before, or maybe even a little bit worse. And you're like, how does this keep happening? Right? It's because in your mind, you think I'm going to take all of my cash and pay down these debts because you're trying to be responsible, right? I can't fault you for that. I mean, a lot of people, they're stuck in these systems. These systems are really designed for you to fail, the financial systems, at least. And it's not really your fault. That's what I'm trying to liberate people's minds, that I've been trying to do this. Why is it always screwing up for me? Because, hey, it screwed up for me. You're listening to a guy that's been through 2 foreclosures and a bankruptcy, okay? I know what it's like to feel like I did everything right, but it all came crashing down on me. So we have now before us the strategy. Look at how quickly we just paid down this line of credit, and it didn't cost. So we paid it off in 6 months, right? We had nothing changed. We still worked our jobs. Money came in. The bills got paid. Everything went just fine. But notice that we paid off all of our credit cards in 6 months, as opposed to 28 years or more, right? So once you've paid off your line of credit, you're not done there, right? You got to understand that it's very tempting when you're doing credit banking, when you free up a line of credit, to think, hey, time to party. Let's go to Vegas. Let's go to Hawaii. Let's go on a trip. Let's buy a big screen TV. Let's celebrate. And now you've taken 1 step forward and 2 steps back. You don't want to do that. There are rules to how we do things with credit banking. And so there's a lot of things, but I want to tell you, first and foremost, you have to have debt, you have to have income, and you've got to have a line of credit. And then once we have that, then we can start implementing the strategy. But if you look back here, when we did this successfully over 6 months, what can happen? Well, quite simply, every 6 to 12 months, your lines of credit are going to evaluate your pattern, your behavior. And if you're paying your credit lines down more than what you're using them every month, and you are using them every month, they're going to see that as responsible behavior. They're going to see that you're keeping your utilization under 50%, even under 30%. Well, that's going to be a boost to you. And then so all of a sudden, it happens to people all the time. You find out, oh, hey, my credit limit's been increased. And I work with an investor who calls it being a victim of a credit limit increase. When you start using credit banking strategies, it happens. It's rampant. It's a phenomenon spreading all over the country. So you started with a $15,000 line of credit, and then in 6 to 12 months, all of a sudden now you have access to $25,000, right? Try that with your checking account. Try saving over time with your less than 1% return that the bank gives you, unless it's a high yield, and then you're maybe making 2%, maybe. Try saving over time $10,000 and see if the bank comes to your door with balloons and a big, huge cardboard check and says, "Congratulations, you now get 10,000 more dollars from us." Never going to happen, right? But if you utilize the credit system correctly, they're going to give you access to more. More of what? More of other people's money. Remember, we're going back to that wealthy mindset. If I use leverage as my currency, and then I use my cash as my vehicle to pay that down, then I'm going to be able to grow the amount of leverage or my total limit, right? So the more limit I have, the more debt I can pay down. So we paid down our balance, right? We had a $15,000 limit. We paid that down. Now we have a $25,000 limit. But in our budget, we still have a mortgage to pay. We have auto loans. Let's take a look at this home mortgage here, okay? So we have our zero balance, right? And I talked about rules. We have a certain amount of rules because we don't want to go out and now spend this money and buy stuff. What is the line of credit for? Well, number one, it's for emergencies. Is there an emergency? God, I hope not. But if there is, you have in your line of credit, you have the ability to take care of that. Number two, your line of credit when using credit banking strategies is for debt paydown. And number three, the only thing you should buy is an asset. Now, some people will say, well, Joseph, that TV I need is an asset, or you don't understand how much I need a vacation. That would be such an asset to me. A lot of people, I don't think, understand the term asset. So I try to define it to people as this. If you purchase something or some things with your credit, your lines of credit, and just by owning it, it starts paying you money, that's an asset. If you purchase something and then because you purchased it, it has more cost involved and you have to pay more and it costs more and more and more, and you never get any money back from it, that's a liability. And so what do we as Americans buy? We buy liabilities. They're all over the place. They're the stuff that's it's all over our house. It's in our garage, right? The stuff we buy. And so we need to realize that if we're going to use lines of credit in the credit banking strategy the right way, there's only three things that we use it for: emergencies, debt pay down, and to purchase assets. That's it. Okay. So we have right now no emergencies, but we still have $200,000 in this loan that needs to be paid off, this home mortgage. So what we're going to do is we're going to take $13,000 as a principal only payment. All right, principal only. So what does that mean? We're applying principal only to the loan. And now I have people who will always ask me, well, wait a minute. You can't pay your mortgage with a credit card. Okay. I'm going to come back to that one for you. All right. Let's hold on to that. Let's pretend for a moment that you can't. All right. So we're going to take our credit card and we're going to make a $13,000 principal only payment. Keep in mind that I said we don't want to go over 50% utilization on these cards. So we have a $25,000 limit. What's going to be 50% of that? Well, somebody will do the math and say, well, Joseph, it's $12,500. You're already $500 over your limit. You're not supposed to go over 50%. I know, but you don't forget we're taking into account our credit banking strategy. So what does that mean? That means that as we pay that off in that first month, right? As you saw the arrows go across your screen, that first month, where are we at? We're at $11,000. So we're actually going to be $500 under the 50% utilization, right? Just in the first month. And everything's going to be calculated on the balance that you carry over. So even though I exceeded 50% utilization within that first month, it paid down to under 50% utilization before the end of the billing cycle. See, that's a key point. It's only what you carry over to the next month. And so if I carry over $11,000 as my balance into next month, well then, as you can tell, I'm already under my 50% utilization. So I'm going to take $13,000 off of my $25,000 limit, and I'm going to apply that to my home loan. It's just going to be an extra payment, not towards the interest, mind you, towards the principal, a principal reduction. So if it took 6 months to pay off 12,000, you can see it's going to take another here we are 7 months to pay off the 13,000. Now, in this scenario, we've paid $1,480 of interest, and after 5 years, let's compare this to what if we were just making the regular loan payments. We're 5 years into this loan, right? If every month we make the $1,200 monthly loan payment, every month, $1,200, $1,200, and we do that for 5 years, that's 60 months, right? You'll have paid $72,000 towards your home mortgage. And the way that breaks down is you have $13,000 going towards the principal. Again, these numbers are rounded. And then you have $59,000 going to interest. So look at that very carefully. Do you see it took 5 years to pay down the mortgage $13,000, whereas in our example using credit banking, we paid that off in 7 months. 7 months versus 5 years. Now, it cost $59,000 in interest. The way that the loan is amortized, the interest is front loaded, so you're paying way more interest up front. So $59,000 of your $72,000 paid went towards interest. In the credit banking strategy, you paid $1,480 in interest. So not only is it faster, but do you see how it's cheaper? It's inexpensive. This is the right way to be paying down your loans, and you want to convert your expensive interest. I mean, it doesn't look like it's more expensive because it's at 6%, but it's amortized in such a way that all the interest is front loaded. 80% or more, 85, 86% of your payment is going towards the interest. And a very small portion of that is actually going to pay down the principal. Over time, you will end up increasing the amount that you pay towards the principal, but that's going to be 222 months into it. That's over 21 years before that happens. So during all that time, the bank is raking in all of its interest first. All right. And they're probably then going to refi you, and then you'll start it all over again, paying them more and more money. You get caught in a never-ending trap, and you're basically in what's called financial indentured servitude. Okay, so the $13,000 principal-only payment saved you $38,866 in interest. How do I know it saved you that much? Because if you made all of those payments, instead of making the $13,000 up front, if you made all of those payments, you would have paid all of the principal and the interest as well. But when you skip ahead in the amortization schedule, and that's what a principal only payment does. You make the principal only payment and then you skip ahead. You actually have gotten in your time machine. Imagine being Marty McFly and you get into DeLorean and you go back to the future, right? 4 years, you make a principal only payment of $13,000 and you've now traveled 4 years into the future. You skipped over all of that interest you had to pay. You don't have to pay it, right? You start where the balance is currently at and you start making your payments there again. And so what did we skip over? We skipped over $38,866 in interest. Folks, not only are you saving money by paying things down faster, but you're also saving money and interest that you're not having to pay. So if you look at this is a breakdown. If we were to continue the credit banking strategy using the lines of credit at 21% interest, and your income doesn't change and your total expenses don't change, right? then that means that your cash flows at 2,000. It would take you 6.33 years to pay this off. Now, keep in mind that this already took 7 months. So take 7 months off of that, and so it's less than 6 years. It's in 5 years. So it took you 5 years to pay off just $13,000 of your house, right? And in the next 5 years, you could completely pay off the rest of your house. So in 10 years, you could completely pay off a 30-year mortgage. And do you see the power of that? Wouldn't it be great to pay off a house, a 30-year mortgage in 10 years or less? In this case, it would only take you 5 more years because we're showing an example where you're already 5 years into this mortgage. But if you started on day one, you could pay off a 30-year mortgage in 10 or 11 years, right? And then if we add in some windfalls and we do some other advanced credit banking strategies, and so what we call the chunking method, you could shave off even more time, maybe pay it off in 9 years or 7 years. I mean, there's so many exciting ways to use credit banking, but look at what you would save. You would save $119,300. In this example on your screen, you would save $119,319. That's how much interest you would skip over every time you do that, because you'd put $13,000 principal only payment and then pay it all down, and then do it again, put another $13,000 principal only payment, pay it down, right? Then if your credit limit increases to 30,000, right, then put 16,000 down and then pay it all down, right? This is the power of the credit bank, because the more you do this, it's going to increase your credit. You're going to see that your debt to income ratio goes down, your utilization goes down, and your credit score goes up. So you're going to be working with better credit scores and higher credit limits. It's really exciting once you start implementing this and doing it. So, I get this question a lot. What if, or they say, if I eliminate our savings, like I've been telling you to, what do we do in case of an emergency then? Excellent question. Remember the rules I told you? The rules of when you use your lines of credit are, number 1, for emergencies, number 2, for debt pay down, and then number 3, for assets. But what's number 1? It's for emergencies. Let's take a look at the emergencies. So we were looking at paying down that $13,000. Well, what if in month 2 we had an emergency come? We got to go to the hospital. Little Johnny broke his arm, and now after insurance covers things, there's still other doctor bills, or maybe we got to pay for the ambulance, or who knows, all these different bills come in, and I got to pay my deductible. So can I put that on a credit card? Yeah. So I put $2,000 there on the card, and next month we just continue with where we're going on our doing. All we're doing is continuing on with credit banking. So instead of getting this done in 7 months, it gets done in 8. The beauty of it is your line of credit is now your new checking and savings account. That's all it is. And so the more you grow your lines of credit, the more you have in savings. I mean, that if your mind isn't blowing up, if brain matter isn't oozing out of your ears, then you don't understand what I'm telling you, and that's okay. What Dr. Joseph recommends is that you continue to attend every week until you get it. All right. So I have people say, I can't pay my mortgage, or I can't pay my car payment with a credit card. And I say, that is true. That is not a lie. When someone says, I've got a credit card and I want to go to the mortgage company and here's my credit card, and they say, we don't accept credit cards. Okay, at that point, do you just tuck your tail between your legs and walk away saying, well, I guess this doesn't work. Joseph doesn't know what he's talking about. No, or do we think creatively, think outside the box? What are ways that we can do this? Well, could I take let's say I have a PayPal account. Could I take my card and run it for the amount that I need, let's say a $1,200 payment. Could I pay myself through my PayPal account, get the cash, and then go make the payment that way? Sure, I can. And someone will say, well, that's going to cost you 2.9% or 3% or whatever it is. I was like, yeah, I might have to factor in those numbers, but that's still way cheaper than making the mortgage payment. Yeah, I mean, so if I make the mortgage payment just every month without doing anything, I'm making that mortgage payment and I'm paying the 6% amortized. Guys, keep in mind that that is front loaded interest. The effective interest in the first year is like 300%, and it goes down, and over the first 5 years it could be you're paying 116% interest, right? By the time you reach the 5th year, that's a whole lot of interest to be paying. So if I'm going to tack on, and the interest, no pun intended, but to pay down my mortgage fast, if I need to tack on an extra 2.5, 3% to facilitate paying down my mortgage in 1/3 the time, and I'm going to save hundreds of $1,000s of interest, it's a no-brainer for me. I'll do that every day. Too many times we trip over dollars to try and save pennies, right? No, it's okay if the numbers work, if you do the math and you're still going to save a whole lot of money, then do it. So if you got a PayPal account or some other merchant service account like that, you could pay yourself the cash you need, right, with a credit card, and you could do it that way. Or another way is here's a company, and I don't work for them. I don't get any. I'm endorsing a company, and they should be giving me a kickback, though. I think they should, because I have a lot of people that use plastic, and it's great. So simply, you can pay anything through plastic. What do? They'll write a cashier's check, or they'll make a wire transfer. As long as you give the account information of where you want the money to go, they'll make the payment to a mortgage company or to the person who holds your auto loan. It's very simple, and that's only 2.5%. That's a pretty good deal. So there are ways to pay your mortgage and your car with a credit card. Not directly, you have to get a third party involved, but it's doable. Totally do it. Some people will say, I don't want to lose the tax deduction on my mortgage interest. And well, with the tax laws being what they are, the mortgage interest tax deduction hasn't gone away. But for a lot of people, there are a lot of people who qualify for double what they have in their standard deduction. But there are a lot of people who don't qualify for doubling their standard deduction. So if you have really expensive interest on your home mortgage, or you have a really expensive house, you live in one of those, $400, $500, $700,000 homes, right? Then the amount of money that you're paying and all that interest that you're paying is pretty hefty. So there's still a segment of the population that really clings to their mortgage interest tax deduction. And so people are like, well, Joseph, I don't know if I want you to help me pay off the mortgage faster, because I really count on this huge deduction in my in my income for my tax purposes. So I'm just going to do a simple little chart to help explain things. Again, this is another case of people tripping over dollars to try and save themselves a penny. So if we have person one who's using credit banking as a strategy, and we have person two who is not using credit banking, person number two is going to take their mortgage interest. Okay, now the numbers here were run on like on a $200,000 house, and with an average income, say, of 60,000. That's consistent with a lot of the examples that we've been sharing in this PowerPoint. But I mean, if we're talking about somebody who has a $80,000 income or $100,000 or more income, and your mortgage interest deduction is obviously going to be much higher because you've been making payments, I understand that the numbers might not match your specific situation, but the math here still does. So the income's the same. Person number one does not take a mortgage interest deduction, so they're going to be taxed at their tax rate on their 60,000. So at that bracket, it's approximately 25%. So they got to pay $15,000 in taxes, right? So if they're an entrepreneur, then they have to pay that, right? That's when you pay Uncle Sam, and or you might pay quarterly depending on how your business is set up. Person number two, of course, they take the mortgage interest deduction, so they're taxed on $48,067. So they are being taxed on less money. So they're also being taxed at the 25% interest rate. So you see, they're only getting taxed, their tax is $12,016. And let's say that was taken out over time through withholdings from their employer. But the difference you see in taxes is that the person number one had to spend $2,984 in taxes more than person two. So that's where person two says, yeah, I don't think I want to give up my mortgage interest rate. However, person number one had more disposable income for themselves throughout the whole year because they didn't take that mortgage interest deduction, right? They're the entrepreneur, right? They paid their taxes on their own terms, so to speak. They either paid it in March 15th or they paid it in September 15th, right? If you filed an extension. But their total disposable income was $45,000. So that's more to work with. And when you're trying to make ends meet, having access to more money is very helpful. Whereas person number two had access to less money. Now, there right there is a financial advantage. Person number one, because they're an entrepreneur, because they didn't take the mortgage interest deduction, they had access to $8,949 more than person number two. But we're talking about the interest savings and the tax deduction. So here is just the tax deduction. What was the interest savings? Person number one, on top of all of that, saved $38,866 in interest that they will not have to pay in that first year that they start. I mean, so you have access to more money, right? Yeah, you paid a little bit more in taxes, but what was the net? You ended up having access to $6,000 total dollars after taxes more than person number two, who is really trying to hold on to the mortgage interest tax deduction. And person number one saved $38,866 in interest savings, whereas person number two, they didn't save anything. So sometimes when you have people who have a whole bunch of reasons why you can't do that. Oh, you can't do that. There are people who sit around and say, no, you can't do that. That doesn't work. Those are the critics. Those are the people who put their own dreams up on the shelf, and then they basically talk you out of pursuing your dreams. If there's a will, there's a way, right? If you want to do this, there is a path forward. I mean, this isn't rocket science. Okay. There is a specific strategy, and you have to stick with it, but it can be done. I had a little message come in here. I had someone say, an apple a day keeps the doctor away. Credit banking, each bill keeps cash flow a thrill. Love it. You know, I've heard an apple a day adds up to 20,440 calories a year, depending on if it's a medium size. You're absolutely right. This is how I talked about why credit banking. This is going to put more cash in your pocket. This is going to make you look so much sexier to your wife, or if you're a gal, more sexier to your husband or to your significant other or whomever, right? You're single and you're looking to find that special someone. Imagine having more money in the bank. It doesn't hurt. I'm going to say maybe people say, oh, you're all about money. Maybe, but everywhere you go, they always seem to want to charge you money. So I guess everybody's all about money. But we're all about how to be responsible, let's get this taken care of. So we've covered in the last 3 weeks budget, lines of credit, and credit banking. Been some amazing stuff, and we've got so much more to go through. I don't know if we have time, but I thought about blowing your minds away with banking and business credit, but what I want to do is I want to jump into an example. All right. So this is audience participation time. We're in Mastermind number 3. So I've got some numbers from somebody who sent us in their numbers, of course. And so I took the liberty of highlighting a couple of things here of what I look at. So the incomes, this is monthly income, $3,200 a month, expenses, $2,600 a month. So right there, I immediately want to know, well, what's the cash flow? And then they share, here's our available credit, and it's $99,790, but their credit balance. So what's their utilization, right? That's what I want to calculate that off of. $59,710. So who's got the answer for me? What is the cash flow? What are we dealing with here? We got 3,200. So we would have, what is cash flow? It's what's left over after all of the expenses have been paid. So how much cash flow do we have here to work with? All right, how much cash flow? Let's see, we got somebody putting in there. Somebody says 6K. Come on, 6K. No. Got 600. All right. But you're probably like me. I do it all the time. I always add extra zeros and everything because I just want to live life more abundantly. So we have $600 of cash flow. All right. Not good. I mean, not bad, not great, right? But I'd rather have some cash flow than no cash flow. So if we have total $99,790 of available credit, but we're using $59,710, what is our utilization? How do we figure that out? Well, we take, we get on our handy dandy calculator. See here, got a calculator. We do, we take 59,710 and we divide that by 99,790. What do you get? What do you get? I mean, I'm going to round, make numbers easier. But what do you get? I see somebody put 73. Well, I don't know. Did my calculator do something wrong? Let's pull up the calculator. All right. Come on. Let's get a calculator up here. Let's figure this out. Okay, here we are. So let us take 59,710 and we'll divide that by 99,790. What do we get? Well, 0.59835. Yeah. So I'm just going to round that up to 60%. You guys see that? Cool. All right. So what's our utilization at? Just under 60% utilization. Okay. So I know we haven't gone into everything yet, but this is what I'm just trying to show you. What I immediately look at income, expenses, and I'm thinking cash flow. I see what the available credit limit is and what the balances are, and I'm thinking utilization. So they have a loan, an auto loan, if you read into this, for this is the balance that's left on $11,500, 23 years. I think Still, is that, no, 23 years. Must be 23 months still left to pay. I don't know if 23-year auto loans. But anyway, but it's only 1.98%, and its cost is $502 a month. And so, and we find out as we read through this that somebody's trying to remodel and finish a house, and the goal is to move in and rent out a couple of rooms. The great thing about the lines of credit that they have here is that they're at 0% interest, because when this person started, they had an 846 credit score. I mean, it's like, that's like a unicorn. I've never seen a credit score that high. But okay, well, I have. My mom has a credit score that high, but she definitely is a unicorn. But now this person's noticed that their credit score has dropped to 643, and they calculated their utilization at 40%, but that doesn't jive with the numbers that they're sharing. But a lot of people calculate their utilization differently. They might look at their total utilization, or maybe they're just looking at it on one card. So what that means is we kind of got to take a look. Now, as they go over I don't get all 8 of their cards. They go over 7 of them. And I don't know what the available limit is on each of the individual cards, but I see the balance. And so, but it's okay. I mean, this is a lot of information. It's a lot of good information. So here's the situation. You see it before you. They have a house that they are working on that they seem to own free and clear. So there's no debt service, but I mean, there's obviously some amount of money for utilities or to pay taxes at the very least. But their bills come to $2,600. If they can finish the remodel, they'll then see a boost in their income they calculate by $1,200. But they have $600 of cash flow to work with. They have a lot of credit card debt. It's not all cash credit. If you look at a lot of these, you've got revolving store cards. You do have some bank credit cards. So there's about, and I have to do some kind of figuring here because I don't have all the information, but it looks like there's roughly around $30,000 of cash credit, while the other 2/3 of this, 66,000 is in about revolving store credit. They need $60,000 of cash to finish this remodel, and when doing so, they believe that they will boost their income, and they want to eliminate. They feel like if they could just eliminate the auto loan payment, that would free up an extra $502 for them, and that would give them more cash flow. So I understand where they're thinking and what they're trying to do, but I want to open this is the mastermind, right? This is okay, kind of also to see where you guys are at. What are you thinking? Where do we start? What do we do? I mean, I have my ideas, but I want this to be interactive. I want to hear from all of you. Where do you think we should start? What should we do? Again, and we also don't have every little minute piece of information, but I feel like we have enough to, and especially for this mastermind today, we can speculate it in areas where we don't have the information and see, like, what would if this person were you, what would you do? Oh, come on now. I'm seeing no activity, not even on YouTube or the webinar. Oh, come on, guys. I am not the only smart one here. I know I am smart, but I'm not the only one. Okay, let's see. We got somebody who's messaging in. Out of the monthly, let's see, it says out the monthly income on the credit card, or put the monthly income on the credit card. And someone says the screen is blurry. Okay, I can see the screen fine. Hopefully everybody can see the screen fine. Perhaps you need to get a pair of glasses. No, I'm teasing you. it looks okay to me. I'm checking it on a couple of other monitors here. But hopefully that'll clear up for you pretty quick. But you're right. I mean, we want to definitely put the income on the lines of credit. But which credit? I mean, we've got revolving store cards, we've got cash cards. Okay. All right, good. All right. So I got some feedback from some other folks saying that this screen is looking good. All right. So, and I'm glad, Keisha, that you caught that was a joke. Thank you. All right. So what are we going to do? Well, this one's kind of interesting because of course you want to put your income onto your cards because that is our credit banking strategy. But we're at 60% utilization, and we only have $600 of available cash flow. William says not put the income onto the store cards, and I agree with William. I think that getting access to as much of the cash credit as we can is okay. So I guess I have to look at what are the priorities. I mean, everybody's got priorities. If we really attack this loan, we could get this paid off in less than well, let's see, 11,500 is the balance. We could probably have that paid off in about 18 months with a $600 cash flow. I mean, I guess just pull out the handy dandy calculator and we'll just calculate it. But we put $11,500 and I divide that by my $600 of cash flow. Oh, 19 months. I am so sorry. I have let you down. I should just get that calculator on the screen. All right. Oh, what I need to do is see if I can split my screen. There we go. Now we're cooking with peanut oil. Okay. So this is how you start looking at things. When you look at your cash flow and you look at debt, how long is it going to take me to pay off this debt? And again, there's always the caveat, is my income going to remain consistent? Are my expenses going to remain consistent? So is there a margin of error? Sometimes our expenses fluctuate, sure. But this is just to help give me a general overall look at it. I'm going to take 11,500 and I'm going to divide that by my cash flow because that's what I'll apply towards that debt every month. So it's going to take me 19.166. So a little over, so it'd be effectively 20 months. So almost 2 years just to pay that off. And then that would free up $502. But then, when I take my $502 and I add that to my $600, now I have $1,102 of cash flow. And then I can start to pay things down much quicker. So I could see a viable option of paying that loan down, but at the same time, there's only 23 months left in the term, and it's only at 1.98% interest. I don't know if that's really that inefficient of a debt. I think that's a highly efficient debt. So we take the amount. So how do we calculate efficiency? We take the balance, right? And then we divide it by the payment and we get a percentage. So it is, that's a low percentage. Anything lower than 50% is something that you would want to pay off. Okay. Yeah, I mean, so I think that if you applied it there, you could pay it down. But with $600 of cash flow, you're going to shave 3 months off of this loan. But in exchange, you're going to grow your cash flow now almost double your cash flow. So that's good. All right, so I got a couple of let's see what's coming in on the chat. We have someone saying don't do the car, it's 1.98%, and they're trying to finish the fixer. Yeah, you see, I got to believe that as we prioritize things here and we look at the fixer, you know, see, to me, this is the real conundrum of this one is they need $60,000 to finish this this fixer, and they estimate right here, I should put this here, that they believe that after, I mean, I don't know how they're exactly calculating this, but they believe that if they finish the fixer, that they will grow their monthly income by an additional $1,200 a month. So that means that their cash flow would grow as well. You know, I don't know if that's going to be net increase to the cash flow. But when the way they're describing it is that they're going to live rent free and still have $1,200 in cash flow because they're going to rent out some of the rooms here in this place. So I would see that as $1,200 more dollars. And so again, just trying to make some assumptions here, but I'm looking at increasing cash flow by, so if we pay off the car, and then this fixer was also fixed up and done, and they put the tenants in there and they're living in them there themselves, and now they have $2,300 of cash flow. That's going to be really easy to use that cash flow to pay off all of this debt. So if we go after the $60,000, we don't have enough, in case you're noticing, because we only have about $30,000 in the available credit. That might be too small for you to see. I might just have to maximize it here. Let's expand that back out again. Oh boy. Okay, I can do this. Come on, Joey. There we go. Okay. So as we look at what we're working with, I just I see with $600 of cash flow, not a lot of option. You could pay that loan off on the auto 3 months earlier and free up $500. That is doable, but that doesn't get you any closer to getting that 60,000. So in the same amount of time, in 18 months, what could we do? Right? We were talking about, let's look at our credit card here. So what we do if we have, clear the screen, $600 in cash flow times 18. So we're basically talking about where's the best place to put $10,800 of credit banking cash flow, pay down debts. So some good questions here. And it's going to depend here, but let's see. I think what we'll do here is we could eliminate the loan there, of course. Eliminate the loan, and then you free up $502 more dollars. You're really cooking. Well, here's what we do. Given the current situation, there is not enough resources to get everything done in the time frame that we need to get it done. So What do I start doing? Well, we have to start looking outside the box, folks. So if we can't get this done on our own, what does this mean? This means it's time to start implementing another strategy. We need to combine some strategies. How could we get access to more credit, but our credit score, is already kind of tanked because we're at 60% utilization? We could get under 50% utilization in about 2 years, right? If we go over here to our calculator here, if we need to get additional funding, we need to get our utilization under 30%. So let's take our total amount that we're in debt and multiply it. So we need to have no more than 28,939. So if we take our $59,710 of debt and we subtract $28,939.10, that means we need to reduce our total balance by $30,770. Okay. So in the first, let's say the first year, we're able to reduce that by about 14,400, just of 2 years of doing the with the $600. But now that's 2 years, and now we divide by $1,102, and that's an additional 14 years. Okay, so now we're seeing, like, man, if I'm going to do this on my own, it's going to take me like 16 years at the small little cash flow that I have. So what do? We have to increase the income. That's one option. So we have to look for new streams of income. We have to start a business. We have to start doing referrals. We have to do something to increase the cash flow. Another option is we could start a business, and we could find somebody who has the credit score, who has the ability to personally guarantee our business for the $60,000 that we need, right? And we could pay this person. We have plenty of money on our lines of credit to make payments on it, but if all we need is 60,000, it is not difficult for somebody who has a 680 credit score with utilization under, right? If we could find somebody who, we are going to look at a new part of it. So what are we looking for? We are looking for somebody, what do we need? If somebody had a 680 credit score and their utilization was under 30%, right? And their DTI, right, was under 45%. This person, somebody like that could, I mean, if you're going to go into business, you don't have to have this person own your business. You might negotiate something, but you've got enough credit to be able to service a $60,000 loan. You just don't currently possess the credit score, the utilization, and the debt to income to qualify for the 60. So by starting a business, your business could then apply for the funding with somebody giving you the personal guarantee. And then what do? You're paying somebody for this personal guarantee. If you build business credit, you have the ability to remove the personal guarantee. Imagine co-signing on an auto loan for your teenager, and then your teenager a year later has a great job. They have a house, and they're doing really well. you can actually get your personal guarantee removed off of the auto loan that you signed for. And so that's really what we're talking about here. So um, we can work with the current situation that you have, and it's going to take time, but using credit banking as a strategy, it'll take less time. But how do we speed this up? How do we get this done in the next year, right? I mean, that's what people really want. Well, we're going to have to either A, increase the income. If we can increase the income, then we can pay all these debts down faster. If that's not an option to increase the income, then the next option is to start a business with its own EIN number and have it start building business credit. Then have somebody give a personal guarantee to the business, and that business can then go out and get some corporate credit cards, right? And then we've already seen ways where we can take credit cards and get access to the cash. We use the cash, finish the loan, finish the rehab. Now you have the rehab and you have the increase of income, and you can also, while building the business credit, get the personal guarantee removed, pay, if you decided to pay this person some money, the use of their good credit. Maybe there's an angel investor. Maybe you have a grandma, a cousin, a brother, somebody that would love to help you out, but they don't have any money. They can't help you that way. And they just haven't thought outside the box. Well, there are many ways to do this. Now, you also might be thinking, I wasn't thinking about going into business. I don't even know what business I would be in. Well, all of you should be in the business of achieving your American dream, your financial freedom, whatever that is. I mean, some of you might actually just be in business to be your own boss, and others might be content working at whatever job you're doing and you like it, and you don't really want to start a business. Having a business not only gives you access to a lot of ways to get funding, but it gives you access to a lot more tax write-offs. There's so many different financial benefits that you can't just say, well, I don't know what I'd be in business for. You could solely just be in the business of financially planning for your future retirement. Your business exists for you to one day retire. I mean, go into business for the purpose of starting a lemonade stand at the end of the driveway. Whatever it is, as long as you're doing something that adds value to somebody else's life, it can begin to add value to your life, and you can get the funding that you need. And a business can take a loan to you on the personal side. There's a lot of ways to get this done. I don't have enough time to really go into it in any greater or further detail than what I have. But given the situation that we're looking at here, I think that this person has a lot of resources. They have a lot of credit. So not all of it is cash. And they definitely can make use of what they have here and definitely get this. They can do this without doing business credit, and they can do this without the help of other people. But as we saw with the math, it's going to take a few years. But if you have the time, then and you don't have the friends, then you can get it done on your own, and you can get this done in a much quicker than you would get it done if you were just waiting to pay everything off on your own. If you were waiting to just make all the minimum payments. That $60,000 also for the fix-up. Does all $60,000 need to be paid up front? Can it be paid over time? Can some of it be leveraged? Could you open up a vendor account with some of those? Pay it off in time? Can they, maybe they could be your partner, right? If you're looking for somebody to be a lender, maybe they'll own a portion of your property and that cash flow that's going to come in from your rental while you are working to pay them off. Folks, what I do, what Ray Fleming does, what the Wise Guys and Ties, what we do is we help people work through all of these situations. These are These are the fun challenges that we love and we help people work with, and we have a lot of clients that we help, and we love what we do. And so, folks, what I want to do is I want to encourage you. Continue to come to this mastermind. Continue to every week, same time, Tuesday nights. This was a fun one. I really enjoyed it. We did use a lot of time here, but we had a lot of good discussion, a lot of good questions that were asked. I want people to know, where do you go? If you want to contact us, you want to get a private one-on-one consultation, your first 30 minutes is absolutely free. And I mean, I do my best to make sure that we give you a ton of value just for the 30 minutes. And if we never end up working together again, so be it. May God bless you. But hopefully, we've given you a lot of food for thought, a lot of things to think about. But if you are going to consult with us, definitely go here to the wiseguysandties.com/credit-banking. Fill out this form, and it gives us information so that we can start working with you. If I call you on a 30-minute consultation and you don't have this form filled out, well, we're going to take up almost the whole call just getting all of the basic information out of you. But if we already start with this information, we can hit the ground running. And then if you need additional help with this, just continue to come on and get on every Tuesday night. What is the purpose of this mastermind? But for all of us like-minded individuals, some of us entrepreneurs, other of us we're in debt and we need help. That's okay. We've all been there, and some of us are further along on the journey, but this mastermind is leaving a trail of breadcrumbs for others to follow so we can find our way out of the forest, right? And come into our dreams. Come into what we were meant to do. What were you put on this earth to do? Were you put on this earth to pay bills endlessly and to have never enough money and to have stomach ulcers over if you're going to be able to pay the rent this month, or can we make the phone payment, or can we make the car payment? This is not what I feel like my life was meant for. I don't feel like your life was meant for this either. And so we have this mastermind so that we can start implementing credit banking strategies to eliminate our debt and increase our cash flow so that we can start living the American dream. And I believe that each and every one of you, no matter where you're at, the person we were looking at today only had $600 of cash flow. Better to start there. I mean, sure, we'd love to have $2,000, $5,000 of cash flow, but we got to start somewhere. And they have a plan. They're investing in some real estate. They're going to make some money. It's a good plan. It's a good start, and they're off on the right track. They've got some probably some equity there, and they can try to leverage that if their credit was better. But implementing a credit banking strategy has the side effect of increasing your credit score and your lendability. So I can't stress it enough that there's no reason for people to live in the shame. At least that's where I was at. I used to have so much fear and guilt over the mistakes that I made. I mean, I'm a husband, and I've got 4 kids, and I went through 2 foreclosures and a bankruptcy. I didn't know if I was going to be able to keep my job. These things stressed me out. I didn't know how to pay my bills. And it's a bad place to be in. And I felt like such a failure. And it doesn't matter. Somebody would show me all kinds of strategies or look at this person's successful, but I felt like such a failure. And I had to hear somebody tell me that it wasn't my fault. And I'm like, what do you mean? Of course it was my fault. Look at all this debt I got. No, I was never taught how to use credit the right way. I was given this credit and I didn't understand how to use it. And every person that taught me or told me how to use it I was just following what I was told, what I thought I was doing everything right. I went to school, got good grades, got the job, got the wife, the house, the car, the kids, and hundreds of thousands of dollars in debt and no way to pay it off and spiraling out of control. And so, yeah, I mean, I didn't know how to budget. No one ever taught me how to budget. So I made a lot of mistakes. I mean, there are a lot of mistakes that I made, but I was unaware of these mistakes that I was making. I thought I was doing everything I was told to do. I was doing everything I saw everybody else doing. So when I found out that the systems that are out there are not really designed for me to succeed, but are actually designed for me to fail, it totally awoken me to a whole new way of looking at things. And when I realized that, okay, so I'm not a complete failure. I mean, yeah, I did make some mistakes, but I didn't really understand the mistakes that I made. Now I can begin again and move forward. And with a mastermind like this, we can move forward smartly. We can do things the right way now, and we can start repairing all the damage that was done to us by people who probably there was no real conspiracy, as it might sound like I'm saying. A lot of people with good intentions thought that they were doing the best they could, or what they understood. And the thing is now that we know how the banking system works, and we know how all these different loans and lines of credit interact with each other, we can begin again. So if your finances have just become a shipwreck, blown up in smoke, the airplane has crashed, right? Okay, now we can begin again. All right, now we have the knowledge. And if you're somebody, I don't even have access to a credit card, there are strategies, there are ways to move forward. You got to tune in each and every week. Next week, Ray Fleming is going to be on the line, and he's going to be covering some great information. And what we want to do is we want to get feedback from you. What do you want us to cover? I mean, we're always going to be covering credit banking and its various strategies, but do you want to hear more about how to calculate your DTI and how to improve your DTI? Do you want to hear more about how to combine business credit with credit banking strategies, how to velocitize those? People talk about that. Do you want to know how to look at your credit score and understand what are things that I can do today to start increasing my credit score, right? There's a wide variety of topics that both my partner and I have been trained on, and we're not teachers in the sense that you come to us as fiduciaries. We're not attorneys, CPAs, anything like that. We're just successful business owners that have become educated. We've utilized strategies and they've worked for us. And we want to be a blessing to you because we were where you were at. And if we can bring you along the way, I mean, a rising tide raises all boats. If we can help our community become more financially independent, then there's more money, there's more capital out there, there's the ability for us to do more. So that's what we want. We want to help everybody succeed on this. Um, I'm looking forward so much to working with each and every one of you. Please go to wiseguysandties.com/credit-banking and register for this mastermind, so you can be in on the other side. Because we usually start up about 15 minutes before the hour, and we have a good little conversation before we jump into this mastermind. So you can be a part of that as well. I want to thank you so much from myself, my business partner, Ray Fleming. We want to wish each and every one of you a good night, and God bless.